In this tutorial, we'll be looking at break-even analysis, otherwise known as cost volume profit, or CVP for short. Let's start off with some terms. The marginal cost is the summation of all your variable cost. For example, the first variable cost can be a certain material, second variable cost can be another type of material, third variable cost can be a direct labor cost. Marginal income or contribution margin is the per unit profit, and it's the selling price per unit minus the marginal cost per unit. The marginal income ratio is the marginal income divided by your total sales times 100. This basically tells you how much of your sales is left over to cover your fixed costs, because in your marginal income you've already covered your marginal cost. Now let's have a look at an example. There's two ways in which you can calculate break-even. The first way is in units, and the calculation is total fixed cost divided by your marginal income per unit. Remember, your marginal income is your selling price minus your marginal cost. So you've already covered all your variable costs. You just need to cover your fixed costs. So this will tell you the number of units that you need to sell in order to break even. And it's the total fixed cost divided by the marginal income per unit. Now let's have a look at an example. Let's say your fixed costs are 2,000 Rand. Your selling price is 30 Rand. Your first variable cost is 7 Rand. Your second variable cost is 3 Rand. So therefore your total variable cost, otherwise known as your marginal cost, is 10 Rand. What is the break-even in units? We've got a selling price of 30 Rand, we've got a marginal cost of 10 Rand, so therefore our marginal income is 30 minus 10, which gives us 20 Rand. That's the per unit profit. Once we sell a unit, we've covered our variable costs. So in order to see how much we need to sell, we need to take into consideration the fixed cost of 2,000 Rand. We divide it by the 20 Rand marginal income, which shows that we need to sell 100 units for us to break even. After you've sold those 100 units, then everything else, your 101st unit onwards, will result in a profit. Now let's have a look at the second way of calculating break even, by virtue of stating or calculating the revenue you need in order to break even. The first way, and there are two ways, is that you calculate your break even in units and you multiply it by the selling price per unit. In this example that we did already on the left hand side, we've got our break even in units, and it's 100 units. We multiply the 100 units by the selling price per unit, which is 30 Rand, which gives us then 3,000. Let's prove it for ourselves. 3,000 Rand is your total revenue. You've sold 100 units at a marginal cost of 10 Rand per unit. This will give you the total marginal cost. But then you also need to deduct your total fixed cost, which is 2,000 Rand. So your 3,000 Rand revenue minus your 1,000 Rand total marginal cost minus your 2,000 Rand total fixed cost will give you a profit of 0. Therefore, you would have broken even. The second way of calculating your break even in terms of revenue is to take your total fixed costs and divide it by the marginal income ratio. Remember what the marginal income ratio is. It's your marginal income divided by sales. Your total fixed costs, if we go back to our example, is 2,000 Rand. Your marginal income ratio, as I've already said, is your marginal income divided by your selling price. So your 2,000 Rand divided by your marginal income, which is 20 Rand, divided by the selling price of 30 Rand gives you your total fixed cost once more of 2,000 Rand and a marginal income ratio of 0.667. This calculation results in a turnover of 3,000 Rand, which is the same as the turnover we calculated when we used the break-even in units multiplied by the selling price above. It gives you the exact same answer. So the method that you use is depending on the information, but either method is correct.